All right, fresh inflation data coming in better than expected this morning. As we were mentioning, Steve Leisman here with the breakdown and more on why recession fears are growing on the street. Hey, Steve.
Hey, good morning, Mike. Yeah, the better than expected CPI this morning offering the best possible setup you could think of for a series of price hikes that could be coming into the system from tariffs. It's a better starting place for the Fed and its ability to cut rates if there's economic weakness and it's needed. Headline 0.2, better than the 0.5 we had last month, a tenth better than the estimate. Core 0.2, that's half of what it was. And you can see what's happened. The year-over-year rate has come down, but perhaps not where it needs to be for the Fed to feel super comfortable about cutting that 3.1% on core, probably a half a point higher than it would be in the PCE. Meat, poultry, fish, and eggs, that was 1.6%. That was a reason for the increase. Energy services, used cars and trucks also higher, but you got some relief on gas. And airline fares was probably the biggest reason for the number coming in below expectation, but that doesn't feed in to the PCE number. Economists at Raymond James writing, quote, there will be some inflationary impact from tariffs, but it is still not showing in the overall numbers. However, even if tariffs impact inflation, the underlying disinflationary trend remains intact. That's important. The outlook for inflation in the months ahead and how the Fed might react, that's one of the uncertainties markets are dealing with. It has some concern about recession. The recent failure of old recession guides means forecasters flying somewhat blind. You can see there the inverted yield curve in the Sommerl didn't work. Recession predictions under Biden ended up being wrong most of the time, or all of the time, actually. Tariffs look like they will have the biggest effect on the supply side, and it's rare for that to be a source of recession. Paul McCulley, economist, says almost by definition, a recession is driven by the demand side of the economy, which gives you the excess capacity on the supply side. Talk to Mike England from Action Economics. He says predicting recessions are problematic because it comes from places you don't expect. Recessions tend to occur from what they call exogenous shock, something that from the outside that's not expected. The economy can adapt to something that's slow moving and well known. The difficulty in adapting, lack of clarity for what is going to happen in tariffs, taxes, and the level of government spending. I don't know if you guys saw, but Justin Wolfers put out what he says is the world's first ever intraday tariff level chart from yesterday.
Intraday?
Yeah, because it went up and down and back up.
Yes, of course.
And Lutnick
Steve,
is on the tape saying that if you think the process is chaotic, you're being silly. But okay.
Yeah. One thing that I did see yesterday, Jim, was your hit with Kelly, which went viral and gets backed up to a large degree in the Journal op-ed pages today. Any reaction to it?
Well, it appeared as if I was speaking for a lot of people who find the process very chaotic and slightly insane. I was not calling the president insane, of course, but I think that there's a way to do this in a way that is less disruptive. And you can say it's a win for Trump when he beats up on the minister of Ontario. But, you know, I mean, that's like not really a fair fight. Is it a win for Trump if you've shaved $3 trillion off of the S&P 500 in search of some unknown goal? You put these steel tariffs in place. There's research, Carl, you know, that shows that you may save some steel jobs, but you end up losing jobs in places that use the steel. And that is those are far bigger industries than the steel industries. Not that I don't feel bad for the steel industries. It just doesn't feel well thought through, Carl. It feels like if you're going to make a major change, for example, where's the White House's economic estimates on how all this works out? How many jobs will you create? How much will it cost? Who's going to lose jobs? What happens when you raise the entire cost structure of the North American supply chain? Well, I know what happens. You've got to erect tariffs in April in order to essentially protect the North American supply chain where you've raised the prices. How long until we get those manufacturing jobs? That will happen when companies start to build in the United States. If there was an estimate or some kind of sense, Carl, that this thing had been thought through, my opinion, my take would be completely different.
All right. Well, that's why Holtz-Eakin is quoted in the Journal today, calling it a horrific start for the economic policy
Carl,
team.
do you remember when we used to get a briefing book from the White House on a major economic change? It was this thick. It had a fact sheet on it. It had the economic estimates. It had how many jobs. And then, of course, you could rake the administration over the coals, or you could say they were right when the numbers came in as they expected or below they expected. But they put their money where their mouth is. They created an estimate. Kevin Hassett, I'm talking to you. Where are the estimates? Before you do these policies, how do you put a tariff on Canada in place, and then 3 days later you talk to the car companies and then you take it off? Justin Wolfers is not lying about an intraday tariff chart. We may have an intraday tariff chart today.
Yep, we'll see if we need it today, too. Steve, thanks. Steve Leisman,
Sure.
we'll talk in a bit.